All right, your railroad cost adjusting factor, chapter 14. The Staggered Rail Act provides for the use of the railroad accounting, RCAF, past inflation costs, the increase of the customer into the rate, and the increase of the rate of the interstate commerce over the comply with the index railroad cost of its own, verifying the index development of others, and to adjust not less than quarterly railroads might implement the RCAF rate, increasing or the railroad cost adjustment factor rate, increasing the commercial commerce approval of the resulting rate, and subject to only limited review of the challenging. All right, specifically Title 49 U.S. Standard Code 10707A 2B states, commencing with the fourth quarter of the 1980, the Commission shall, as often practicable, be not less than even often quarterly publish a railway cost adjustment factor, which be in a fraction of the numerator of which the latest published index of the railroad cost, which index should be complied with, verified with the Commission with the appropriate adjustment to reflect the change in composition of the railroad cost, including the quality of the mixture of the material and labor, the denominator of which the same index of the fourth quarter of 1980 or the fourth quarter of 1982 as for the fourth quarter of every fifth year thereafter is appropriate. It is present that the railway cost of adjustment factor is calculated by using it as an index of industrial-wide practice of the interstate commerce. This is considered compilation for the railroad cost adjustment factor is an ex parte number 290, subpart number 1, railroad cost recovery procedure for proceeding. The Interstate Commerce Commission Association of American Railroads compute the index of the Staggered Rail Act, subject to the Interstate Commerce Commission review and approval of as January 2nd, 1985, individual price index components upon which the railroad cost adjustment factor is based. Just the following categories: labor, fuel, material supplies, equipment rents, and car hire, lease payments, depreciation, and other expenses. Generally, the railroad cost adjustment factors development of the forecast precise components for the compromise the AR index subsequent quarters prices of some of the components for the index or the forecast from other components that represent the actual price of the projected further to the account the difference between the projected date and expected use price index components multiplied with their respective weights and subs submitted to obtain the composite indexes. The component weights are adjusted annually to reflect the change of the composition of the total cost of the previous year. All right, the Interstate Commerce Commission is forecasting an actual index values that are identify the major problems of the forecast index, the underlying methodology of the asset to validate the forecast index value of the basis previous forecasting accuracy. In addition, with its own procedure, the Interstate Commerce Act also requires the Association of American Railroads to engage the independent public accountant to audit the procedure involved with the calculating of the index. The Interstate Commerce Commission decision to adopt the railroad cost adjustment factor developed the AAR pricing index challenge because the project was not included with the Western Coal Traffic League of the United States, and cert denied. The court rejected the arrangements of the Staggered Rail Act. Statutory requirements preclude the productive adjustment of the index used translate the inflationary cost of the increase of the rate. The increase the course rejected the arguments inadequate revenues provided by the independent region with the non-adjustment of the index. The productive adjustment would undermine the incentive of the growth. Nevertheless, could be confirmed with the Interstate Commerce Committee ordering the establishment of the railroad cost of accounting railroad cost adjustment factor ruling from the Interstate Commerce Commission acted responsibly, including with the methodology problems measured with the productivity adjustment not inappropriate with it at the time. However, the form of the Interstate Commerce Commission ordered the court expressed the exemption of the interstate commerce would proceed with the state initiation of reconsider the omission of the productivity of railroad cost accounting cost for adjustment factor. Ex parte number 290, subpart number 4, served in 227 1984. Interstate Commerce Commission requested further comments for the applicability product adjustment of the requested railroad cost adjustment factor, particularly the comments for the Cave and Christian method as the date of the report. Interstate Commerce Commission has not issued a decision. All right, application of the principles to the railroad cost accounting factor. The product principle required for the cost indicative measure change of the price and change of productivity. The requirement the best accomplished for the adjustment, the increase for the incorporated change of productivity, as well as input price of the productive adjustment. Railroad count cost adjustment factor is neither the statutory required or no precluded. Adjusting of the railroad cost adjustment factor productivity is an issue which must be resolved by the Interstate Commerce Commission in rulemaking. However, the railroad accounting principle believes the productivity adjustment necessary for the railroad cost-effective factor to measure the cost of the change accurately. The product principle does not recommend the specific productivity measure of the model, the selection of the specific model, the procedure for applying this model, implementation issues the best reserved the Interstate Commerce Commission. The railroad accounting principle board believes that relying on the existing work presently available, the expertise and appropriate product measure should be implemented within 18 months of the publication of the railroad accounting principles. Alright, analysis supporting rejection chain of the application comments received addressing the issue of concern with the double recovery pass through the productive gains, revenue adequacy, pricing, the freedoms, incentive, and issue of practicality. The comments raised of the points addressed extensively before Interstate Commerce Ex parte number 290, subpart number 4. Railroad accounting principle considered the rejected commended the irrespective of the railroad accounting adjusting factor to measure the non-productive adjustment made by the railroad accounting cost adjusting factor. It rejected the alternatives on the basis of the analysis of the 6 issues: economic accuracy, contestability, double recovery, productive gains, revenue adequacy, pricing freedoms, incentive, initiative, and practicality. Alright, economic accuracy. Although economic accuracy is discussed in Chapter 8, the key issue of the application of the productive principle of the railroad cost adjustment factor changes the input productive and output in either a single measure of the volume as or composition of the measure. As a major source of the change in total cost of the experience, the definition of the general level output inflation, increased costs, productive growth reduced through them, and implying that the input price indexes without productive adjustment may be cause costs to change and appropriate appear greater than they actually are. A simple illustration may be demonstrated at this point. Alright, the effects of productivity on the change of the cost. In the example, the input prices would be 1.25% at $50 to $40, while cost index would be 1.0625%, 42 to 50 to $40. Railroad count adjustment factor currently formulated only would produce the accurate measurement of the change of the output, but on unit cost of the one period of the next within their non-productive change. That when the productivity changes is implicitly valued as zero in calculation. Contestability is a significant argument with including productive adjustment and limitation. Contestability adjusts the base rate defined in the Title 49 U.S. Standard Code 10707A2A. Adjusts the base rate means the base rate of the transportation particular commodity multiplied by the latest rail cost adjustment factor published in the Commission pursuant to the subparagraph. Under the Title 49 U.S. Standard Code 10707AB2, increase the rate with the application of railroad cost-effective factor. Base rates must not exceed the reasonable maximum. Therefore, potential overestimating the railroad cost increases is a crucial issue. Alright, double recovery on productive gains. Some parties have stated that the incorporating of the productive adjustment might result in double passing through productive gains in and for the cooperative region with the railroad has already held down a rate increase. However, their argument follows only the implementation methodology that may be produced for the effect described. According to the statute, the base rate, not individual existing rate currently charged, is adjusted for the railway cost adjustment factor. This, the railroad has held back any portion of the rate increase for the past. The current rate will be not affected as long as it has or below the adjustment railway cost adjustment factor times the base rate. Other procedure implementation railroad cost adjusting factor increase may be precluded at any problem from occurring. Alright, revenue adjusting pricing freedom. A view of the role productivity reviewing revenue with the adequacy determination. Any diverse some parties stated in small overestimating productive measurement could have serious consequences of the railroad industry. General revenue inadequate. However, the other argue the revenue adequacy is separate from the issue of the productivity. Productive adjustment, the railroad cost adjustment factor should not preclude the railroads from achieving their revenue adequacy goal. The revenue cost adjustment factor does not constitute a rate ceiling, except it's the case for the captive traffic already bearing rates above the Interstate Commerce Commission to determine the maximum rate reasonable level. Other procedures are generally available to railroads seeking the additional rate increase of the road, the rate flexibility of the revenue, adequate the individual rate increase and above the level. However, they obtain the individual rate adjustment through the current procedure other than the railroad cost of adjustment factor requires the additional time and effort of the part of the railroad. Incentive to initiative. The diverse views of the help of the effective productivity adjustment with the incentive to innovate with some of the particular party that have been productive adjustment would be reduced the railroad industry incentive to increase productivity. Others would maintain the regulation should be result in rates approximately those which would be set under the competitive conditions. It has been stated that innovators are competitive and marketers do not transfer their customers the full amount of the productive gains immediately. In the short run, firms are retain the share of the gains in form of increased profit margins or reduced losses. Except for the increased return, the firms would have no incentive to incur the risk of the cost of innovation. In the long run, other firms attempt to gain the same of the benefits for themselves, eventually forcing markets to level the common rate, current productivity of the cost to level. The process, however, that may take many years. The innovating the firm of the competitive marketplace may retain the significant share of the benefit and it's occurring from its productivity gains. Other than having observed every productivity adjustment based on the industry-wide experience, each of the railroad would remain motivated to improve its own performance since resulting cost of the savings flows directly into the net income. The railroad should continue to see profit increase from the industry-wide productive improvements until these improvements have been experienced long enough to fully represent the higher level of the productive trend line. The railroad may benefit from the productive gains even where their rate increases they are reduced from the full amount of savings in costs, since profits may increase to the extent with a higher volume of the traffic results from lower freight rates. Some economists consider the competition regulatory lag of the two motivators of innovation. The competition helps to increase the efficiency, productivity, and innovation of the strength of the industry, and recognize productivity on a lagged basis. Also, innovators to keep the gains of the productivity improvements for a certain amount of the time. Practicality. Some of the commentators expressed with related with concern inaccuracy in any of the productivity measurement of the technique may be permitted with the other 100% of the productivity gains that may be passed to the shipper. In such case, the railroad would be penalized for any of the productive gains. The Railroad Accounting Principal Board believes that implementing the particular method of the Interstate Commerce Commission with the procedure to minimize the potential overstatement due to the inaccuracy of the measurement of the technique. Several approaches has been suggested by the Railroad Accounting Principal Board minimize the overstatement, such as the use of a symbol division of measured productive changes, laggard measured, or sophisticated statistical techniques. Railroad Accounting Principal Board takes no position on merits of any of these approaches. The Railroad Accounting Principal Board has reviewed information regarding the several productive modules. It also concludes the practical productive methodology can be implemented with the time manner which the use of the combination input prices indexes, which yield economically accurately measure the cost of the change. The Railroad Accounting Principal Board recommends the appropriate productivity adjustment of the railroad costing adjustment factor and being implemented by the Interstate Commerce Commission within 18 months. Alright, Part 3, General Purpose Costing Systems.